Something just broke in the Richmond multifamily market. For 12 straight months, one number stayed frozen in place. Property owners got comfortable, underwriting models stayed consistent. Then November hit, 6.4%. That single data point just invalidated every deal analysis written in the last 6 months. And if you're still using old assumptions, you're about to get caught on the wrong side of the repricing event that most investors won't see coming until it's too late. Here's what almost no one is talking about. This isn't just happening in Richmond. The pattern is showing up in 3 other markets right now, and the math says yours could be next. The investors who figure this out in the next 30 days will reposition before the herd moves. Everyone else, there'll be the exit liquidity. I'm going to show you exactly what changed, why it matters more than vacancy as ever before, and the one number you'll need to recalculate every deal you're looking at right now. When vacancy rises by nearly 100 basis points in a single quarter, 3 things happen simultaneously that most investors don't see coming. First, the debt markets tighten. Lenders who were comfortable at 1.2 DSCR coverage 6 months ago are now demanding 1.3 or higher. Why? Because they've seen this movie before. Rising vacancy often precedes rent softness, and rent softness kills cash flow. Second, buyer psychology shifts. Institutional buyers who were penciling 6.2 to 6.5% cap rates in Richmond are now modeling 7 to 7.25% minimum. That's not pessimism, that's risk adjustment. When occupancy becomes less predictable, return requirements go up. Third, and this is the part that catches sellers off guard, the pricing gap widens. Sellers who are anchored to 2023 valuations are about to discover that buyers are living in 2025 reality. And 2025 reality includes higher vacancy, tighter debt, and cap rate expansion that compounds every month you wait. And here's why this matters more in Richmond than other markets. We've had an artificially stable occupancy environment for nearly 3 years. Investors got comfortable, property managers got comfortable, even lenders got comfortable. But comfort in real estate is often prelude to correction. The data I'm about to walk you through isn't just numbers on a screen. It's early warning indicators of a capital market shift that's already happening, whether you see it or not. The analysis, the numbers deep dive. Let me break down exactly what's driving this vacancy spike and why it matters for your underwriting. Overall market dynamics. Richmond's multifamily vacancy jumped from 5.2% in August to 6.4% in November. That's a 23% increase in occupancy pressure in just 1 quarter. But story gets more interesting when you dig into the submarkets. Class A properties are leading the decline. New deliveries in Scott's Addition added 8.4 units to the market in the last 6 months, while Manchester saw 623 units come online. The problem? Absorption isn't keeping pace. Scott's Addition is running 9.2% vacancy on newer assets, and Manchester is at 8.7%. Class B assets are showing more resilience, but with warning signs. Vacancy is up from 4.8 to 5.9%, which seems manageable until you realize that's where the bulk of investor demand has been concentrated. When Class B starts softening, that's your institutional buyer base rethinking their allocation. Class C remains the tightest at 4.1% vacancy, but here's the concerning part. Collections are deteriorating. Property managers I talked to are seeing 30-day delinquencies creep up from 2.3% to 3.8%. That's not vacancy yet, but it's the leading indicator. Capital markets reality check. Now let's connect this to what buyers are actually underwriting. The 10-year Treasury closed Friday at 4.7%. Delete that, ignore that. Agency spreads are running 215 to 235 basis points depending on leverage and property quality. This puts all-in debt costs at 6.6 to 6.8% for well-sponsored deals. Here's a math that's reshaping your buyer behavior. If your debt costs 6.7, you need 130 basis points above spread for acceptable DSCR coverage. You're looking at a minimum of 8% cap rates just to hit basic return thresholds. But most institutional buyers want 150 to 200 basis points over the spread to cover the cost of capital. Translation, 6.25% cap rates that trade freely 6 months ago are mathematically impossible. Buyers who are still competitive at 7.4% caps, depending on asset quality and submarket dynamics. Submarket breakdown. Let me get specific about where opportunity and risk are concentrated. The Fan and Museum District are holding up better than expected. Vacancy is 5.8%, which is elevated but manageable. The demographic stability in these areas provides some insulation, and the housing stock constraint keeps rental demand relatively inelastic. Short Pump and Western Henrico are showing stress. Vacancy hit 7.2% last month, driven partly by new supply, but also demographic shifts. When family-oriented rental demand that drove the market for 5 years is softening as more households transition to ownership. Churchill and the East End represent the biggest opportunity risk paradox. Vacancy is tight at 4.9%, but that's because very little institutional quality products exist there. For buyers willing to take development or heavy value add risk, the fundamentals still work. For stabilized cash flow investors, the options are limited. Southside Richmond is where the real stress is showing up. Vacancy jumped from 6.1 to 8.3% in 3 months. That's not just new supply, that's demand destruction. Buyers are avoiding the area entirely early, which creates opportunity for country area capital, but only if you can underwrite the recovery timeline correctly. Case study, real world example. Let me walk you through a deal that's happening right now to show you how these dynamics play out in place. 156 unit Class B property on the northwest side came to the market September. Built in 87, recently renovated, solid management, 94% occupier at the time of marketing. The seller priced at $147 per door, which penciled to a 6.4 cap rate based on trailing 12-month NOI. 6 months ago, that deal would have been under contract in 30 days with multiple offers. Here's what's actually happened. First, the showing activity was decent, but not competitive. Buyers toured the property, ran their analysis, and walked away. Why? When they stress test the vacancy assumption from 6 to 8% and model rent growth at 2% to 4%, the deal stopped working at the asking price. Second, the financing landscape changed during the marketing period. The buyer who eventually emerged couldn't get debt at the terms they initially modeled. Instead of a 75% LTV at 6.8%, they secured 70% LTV at 7.1%. That financing shift alone reduced their maximum supportive price by $1.8 million. Third, the buyer's return requirements shifted during due diligence. The investment community, which targeted 7.5% IRR 6 months ago, bumped their hurdle to 8.2%. Not because the property got worse, but because the market got riskier. The final contract price, $133.5 per door. That's 9.2% haircut in the asking price, and it pencils to 7.15% cap rate based on the buyer's adjusted NOI projections. Here's a critical insight. Same property, same cash flow, same management. But the capital markets environment shifted the risk-adjusted pricing by nearly $2.1 million. The seller who waited for the 2023 pricing got 2025 reality instead. This isn't an anomaly. I'm seeing similar patterns across 15 deals in various stages of marketing right now. Buyers are repricing risk all the time, and sellers who don't adjust are sitting on the market with no viable exits. So where are the Richmond cap rates headed through 2025? Based on current market fundamentals, here are the scenarios that I'm modeling. Base case, moderate expansion, 70% probability. Cap rates drift higher to 50 to 75% basis points over the next 12 months. Class A stabilize around 7%, Class B 7.25%, and Class C 7.75 to 8% for quality assets. This assumes vacancy plateaus around current levels and debt markets remain stable. Bear case, significant correction, 20% probability. If Richmond's under construction pipeline of 5,037 units delivers faster than expected and absorption weakens, vacancy could climb past 10%. In that scenario, cap rates could expand by 100 to 150 basis points, putting Class B assets in the 8+% range, making institutional financing very challenging. Bull case, quick stabilization, 10% probability. If job growth accelerates significantly and absorption rates catch up, vacancy might return toward historical averages by late 25. This would limit cap rates to expansion 25 to 50 basis points, with Class B settling around 6.75 to 7%. My assessment, we're tracking closest to the base case scenario. Richmond's 5,000 units under construction represent 4.7% existing inventory, well above the national average 2.6. The key variable, absorption. Richmond absorption has been strong over the last 12 months. If demand holds at these levels, the market can absorb the new supply without major disruption. The smart money is already positioning this new reality. Cap rate expansion of 50 to 75% basis points isn't a market crash, it's a recalibration towards sustainable market conditions. Here's your takeaway, and here's what this means for your strategy, whether you're buying or selling. For buyers, higher vacancy isn't a red light, it's a filter. The deals that survive today's stress test underwriting are the ones that will compound value through the next cycle, but you need to model conservatively. Use 7.5 to 8% vacancy assumptions, cap rent growth at 2% annually, and build in 50 basis points of additional cap rate expansion risk. For sellers, don't wait for yesterday's pricing to come back. Build your exit strategy around today's buyer math, not last year's comps. If you're holding a stabilized asset and the fundamentals are solid, price it to move. The carrying cost of sitting on the market an extra 6 months while hoping for better pricing will exceed the haircut you take today. For operators, focus on occupancy and collections above everything else. In a rising vacancy environment, every percentage point of occupancy outperformance translates to meaningful NOI protection. This isn't the time for aggressive rent pushes or deferred maintenance. The smartest capital is already adapting to this new reality. The question is whether you're ahead of the curve or behind it. If you're buying, selling, or need real cap rates that buyers are underwriting now in Richmond, Hampton Road, Southern Virginia, book a call with me. I'll walk you through the submarket level data, current financing landscape, and the deal structures that are actually getting done in today's market. Don't make decisions based on 6-month-old assumptions. The market has shifted, the math has changed, and the window for repositioning your strategy is narrowing every week. Book a call with me in the description below. Let's make sure you're positioned to win in the market we have, not the one we wish we still had.